So it looks like old Deutsche Bank is going to finally start their mass layoffs. They've announced that they're laying off in this first wave 18,000 people, which is about 20% of their overall workforce from what I understand. I guess most of these firings are going to come from their London and New York branches. I guess their investment banking division has not been too good. And this is not really being limited just to floor traders. The head of the investment bank division of Deutsche Bank, who's been there for like 20 years, I guess in his farewell letter, he wrote that he started working at Deutsche Bank, I guess, right out of college in his early 20s, and he worked there until now, and now we're there at the end, and he's getting laid off too with everybody else. Now, this is really no surprise. It's been understood that Deutsche Bank is in bad shape, really, since the financial crisis. They never really turned things around. They've been kind of clinging to life support for the last 10 years. When all the banks' stock prices plummeted in the wake of the 2008 crisis, they all eventually, kind of turned around and came back and made new all-time highs throughout the world. The ones that survived the crisis. Of course, Lehman never came back since they went bankrupt. But Deutsche Bank pretty much stayed down where they were since 2008, and they've stagnated. And their approach for a long time was to try and grow out of their troubles and try and just make so much money that it didn't matter that they had all this bad debt that they were hanging on to, that they owned, that this yoke around their neck. They were just going to try and build up their muscles so that they didn't feel the yoke around their neck instead of picking it up and throwing it off. And that hasn't worked. They're still down in the dumps. And so finally, there's this new CEO who's been in office now for some time, and he's decided, we're just going to start cutting. We got to trim the fat. And that's the only way that we're going to get into shape. Now, what I've been trying to figure out, because I don't really care that much about one particular bank, is how this will affect the rest of the market, because I'm an econ guy, not a finance guy. I understand how the financial system works and why there are a lot of problems in it, broadly speaking, from a theoretical perspective. However, when we get down in the nitty-gritty of the strict mechanics of modern finance, I really am at a loss, because that's just not my field. I haven't studied it at length. I only really look into finance to the extent that I need to understand it in order to analyze our modern economy. So understanding exactly how bad Deutsche Bank's positions are, or how unhealthy it is, or how, say, a potential collapse of Deutsche Bank would impact the rest of the financial system is something that is very gray to me. I don't really know one way or the other, because there is a debate amongst the finance people. There's a debate going on over whether this matters at all. There seem to be two arguments. The first argument, of course the bearish argument, is that Deutsche Bank has something like 48 trillion in derivative exposure, and that if Deutsche Bank went under, all of those contracts then could not be completed, because if Deutsche Bank is bankrupt, they can't hold up their end of the bargain on these derivative contracts, and so therefore you would have all these other banks that they are working with, they would lose money, and then those banks would start to go under, and then this would just spread contagion throughout the whole credit market. And essentially, Deutsche Bank would serve in that sense as the next Lehman Brothers, because that's of course what happened with Lehman Brothers when they went under. Everyone who was exposed to Lehman Brothers derivative contracts lost a bunch of money, and then they started to go under too. Now, the bullish case in this case, or rather the not so bearish case, so it's not exactly bullish, they're not telling you to go out and buy Deutsche Bank stock or anything. They basically say that, oh no, you can't just look at their derivative exposure, you have to look at their net exposure, which we don't actually know what the net derivative exposure of Deutsche Bank is. There are estimates that it's about 100 billion, and that of course is a lot less than 48 trillion. Now, what is net exposure? Net exposure basically means their exposure to either the long side or the short side of the trades. And the smaller an institution's net exposure is, that just means that they're, the better they've hedged their positions. Essentially saying that the downside risk is that they would only lose, $100 billion or something like that. I guess that's how it works. However, they don't. It's not like they have the long and the short side of every trade. I don't believe. I think this is overall how many positions are they short, and how many, in dollar terms, and how many positions what's their long position in everything in dollar terms. So this is a better metric of the health of the financial institution itself, and less so a measure of their interconnectedness with the financial system. Essentially, the folks at the article I was reading was in the Financial Times published today. Their point is that it doesn't really matter that Deutsche Bank has this huge $48 trillion in derivative exposure, which would essentially mean that they're pretty well intertwined with the global financial market, and that there's a lot of money tied up with Deutsche Bank. It doesn't matter because Deutsche Bank's not going to go under because they don't have a very big net exposure, so the risk of them going under is not that big. That's their point. Now, from what I understand, however, if Deutsche Bank did in fact go under, you would have that 48 trillion sort of go poof and disappear because Deutsche Bank would no longer be able to hold up their end of any of those trades, or rather their end of those contracts. So essentially, the way I understand the Financial Times' argument is that basically, they're saying if there's really that much at risk, do you really think that Deutsche Bank would be so stupid as to lose all that money and go bankrupt? You silly fools. Their point is basically that people should have faith in the ability of Deutsche Bank to not lose money, even though Deutsche Bank has been losing money for quite a long time, and they're not a very successful bank. It seems that there is a consensus that Deutsche Bank is in trouble, and so therefore it would seem reasonable to look at the risk of who would be affected if Deutsche Bank in fact went down, not just the risk of Deutsche Bank actually going down. Because that is the problem when you have really big banks like this, is a lot of money flows through them. They're like channels in the financial system. And this Deutsche Bank is one very big channel. It's not quite the Strait of Hormuz, but you could say perhaps that were this channel to be closed, the financial system would be pretty well locked up, and you'd have to force a lot more money through a lot fewer holes. Now, if you're a finance guy and you understand this stuff better than I do, I would be very happy if you could leave a comment below giving your opinion on whether or not I seem to be misinterpreting this or not. But it would seem to me that if Deutsche Bank actually does go down, that it certainly would be very much a Lehman-type situation where you have all these people who are stuck on the other side of the contracts now who aren't going to get paid, which of course could likely lead to another financial crisis. And of course, I don't think that Deutsche Bank is somehow the cause of this, but this certainly would be the spark. Now, if you gained anything of value out of this video, I'd appreciate you clicking that like button and subscribing. And if you do subscribe, please do click the bell, because I do upload every day, and I'd hate to have you miss one. So I'll see you folks back here tomorrow.